Welcome. Our goal is to spread financial knowledge to everyone, everywhere, all for free.
Hi. So Volkswagen has a PE ratio of 4.5. Is it an opportunity to invest in the stock? We'll look at the most important indicators to see if this company, being in a highly competitive environment, is a buy, maybe for a short-term perspective of, I would say, couple years, in order for the valuation to go back to reasonable levels. In my opinion, it's not the top pick you can do on the stock market. I follow the Warren Buffett approach, and the quality of the business and the competitiveness in its own industry are the top priorities for me. But following the classic Benjamin Graham strategy of buying low and selling high, which brought him returns better than the market average, indicates that this stock might be a great buy. And I don't think we can call it a cigar butt approach, because the company, it's in a very highly competitive environment, as I already said, but me and many others, they strongly believe in the product. What I mean is that I talked with a guy who told me that talked to a high executive in Volkswagen, and he told me about their recruitment process and that they are looking for people with Audi gene. What does it mean? They are looking for people who use and are obsessed with Audi. And there are truly people like that. So this company has a big moat that comes from their brand. And that strong brand is something that is not indicated in the financial report. Of course, they have goodwill, etc. But it truly is a value that cannot be represented in any amount of money, because the brand just stays in the customer's head. It's nothing tangible, it's not a program. You cannot ask accounting to put that on your balance sheet. So that's an extra value that is basically hidden. Okay, let's jump into the indicators. So let's start with the most basic, price to earnings, 4.5. I mean, that just sounds amazing. We also have price to sales of 0.2. Price to tangible book ratio is 0.71. And just regular price to book is 0.33. But, with the tangible ratios, I always try to use it as a defense mechanism, because intangible book value is very easily manipulated. Like, I tried talking to many accountants about how do we calculate the real value of the intangible book value, and can it be calculated from the perspective of an investor. And they always said that it's a tricky, slimy subject, and Benjamin Graham was teaching the same. He always subtracted all of the intangible book value from his valuations. It acted as a way to make sure that even when your analysis shows that this asset, this stock is underpriced, you'll have even greater safety, knowing that you actually made those indicators worse because you subtracted that intangible book value. So you can be 100% sure about your ratios, basically, about your data. So in here, price to tangible book value, so only the material assets, is 0.71. So it looks really good. I will check it also on the chart to tell you how they look over the years, if it will let me. It won't. I will check it at the end. Or maybe let me pause. I will be right back. Okay, so if we look back, the earnings of the Volkswagen Group are very stable. There were only 3 quarters in 2016 where Volkswagen made a small loss. The net margins were around -1%. So I don't think that's a big deal. Let's look at other ratios. Let's look at the margins of the group. Okay, so the net margin right now is around 6%, operating 8.5% and gross 20%. So those margins for Volkswagen are now stable. They are beginning from 2014 to 2023. Those margins were around 5%. They dropped once, as I told you, in 2016 to -1. And also in 2020, so COVID, they dropped to 2%. I'm talking about net margin. The operating gross, they look similar. The gross margin, of course, being higher. Those margins don't indicate competitive advantage, but they indicate stability in money generating by the company, which in my opinion is also highly important. If you look at the price ratios, the PE 4.5, the price to book value 0.7, enterprise value to EBITDA 3.5, although EBITDA is kind of bullshit earnings. It is commonly used by investment bankers to basically show the financial ratios in a better light. So we don't use that one. It's just bullshit earnings. I think that should be enough of an explanation. And that's not my opinion. Of course, it also is my opinion, but Warren Buffett pointed that out first to me. Let's look at the dividends. So forward annual dividend yield is 8.1%. So I think it's a great yield. The payout ratio is 40%, although I don't know based on how many years that is. So I would have to check that out later and see how the recent years behaved in terms of dividend. We also have 23% shares held by institutions and 0% by insiders. Sorry for a long pause, I'm thinking. Okay, let's go to the cash. So we have total cash per share of 90, while the stock price is a little bit around more than 100. So yeah, it's like 75% covered by the cash. But sadly they have a ton of debt. So 45 billion in cash and 202,000 billion in debt. So they're heavily leveraged with small profit margins in a highly competitive industry. So I would go on into the analysis and check the type of debt that is. Because if it's from the government, if it's from a different company, it all depends. The debt might be with very low interest. We are coming back from the dovish monetary policy due to COVID. Now we are changing. But if that debt is a long-term debt, maybe they have very good interest on that, and the real interest might be actually negative. So the amount of money that they pay extra because of the interest is lower than the inflation. So their debt is decreasing quicker than the interests are gaining. The current ratio of the company is 1.2. So it looks like the company will be able to pay its debt, even though it's quite a lot. And if you look at the revenues in the last 5 years, the average growth is of 4%. So we have a company with a PE ratio of 4.5, and we have similar growth. So it's a great opportunity. Peter Lynch also has an indicator that works by comparing the PE ratio and the growth rate. So in this case, with 4.5 PE ratio on a share that is in Germany, where in the DAX 40, the average PE right now is a little bit above 12. Having such a small PE with positive growth rate of 4%, well, it is just an amazing bet in my opinion. Although, as I told you before, there are many things that has to be checked, and that type of short analysis only based on financial statements, it just shows that it is worth spending more time doing the analysis, but it is not a signal to buy. Deciding to buy on such a small amount of data probably won't get you far. And yeah, remember that I'm a long-term investor, a long-term value investor based on the Warren Buffett approach. So this company might look at least like it's undervalued, but the market might go even lower or might stay very low for even a longer periods of time. So I wouldn't be surprised if in 2 years' time maybe the stock price doesn't move. I mean, it's unlikely if it's a true undervaluation, but sometimes it can take a really long time until the market expresses the real value of the business through its share price. Okay, I think that was helpful. I really like the stock. I will most probably look more into it if I have time. And yeah, I hope it helped. I hope it was clear, although this episode wasn't really for beginners as I wasn't explaining all of the ratios. I will probably do that episode later on, so everyone can understand what the fuck I'm talking about. But thank you for listening, and I wish you a great day. Bye bye.